Hi everyone, this is the online lecture for GDP. Other than GDP itself, we'll be also looking at the circular flow of income, which is a very general and holistic way of looking at the economy, as well as business cycles. All right, let's start. Now, this is the circular flow of income that you have seen in lecture. Now, the circular flow of income is created by these two actors in the economy. One is a household. Household is a regular people in families like you and I. Okay, so households is one actor, and the other one are the firms. Now, the firms wants to produce, but they don't have any resources to begin with. The resources are held in the hands of the household. If you remember last week's lecture, some of the resources include land, labor, capital, entrepreneurship. Now the household hold them. Okay, for example, there's people in the household, so there's labor. Those people could be highly educated, so they could be human capital. The household could be sitting on a plot of land, so these are resources that the firms can use. So an exchange begin to take place. The firms will buy the resources from the households and start producing goods and services. Okay, the household would earn factor payments. All right, so when the firms use labor, for example, from the household, they're going to pay them salary, right? Or when the firms need the land that the household is sitting on, maybe they buy or they rent. Okay, so the household earns something. So when the firm starts producing goods and services from the resources, the household with the income earned, all right, with the factor payments earned, household would buy things from the firms. Okay, so between the two of them, they create a kind of exchange and a circular flow of income begin to evolve. Okay, now this circular flow of income is not airtight. All right, there's external sectors that can change the amount of circular flow between the two parties. Okay, now these three external parties are financial institutions, government, and rest of the world. Now, these three sectors can either increase or decrease the circular flow of income between the household and the firms. Now, when it is a decrease, can you see the downward arrow? If it's a decrease, we call this a withdrawal. That means income is being withdrawn out of this circular flow. Now, these three withdrawals are savings, okay, taxes, and imports. Now, why do these withdrawals decrease the circular flow of income? Now, in this case, when a household decide to save money, that means they don't spend. Okay, so that money could otherwise be used to buy goods and services from the firms, but the household decide to save them, okay, into banks, okay, and other financial institutions. So this withdraw the business that could otherwise earn by the firms to the financial institutions. Okay, so savings is a kind of withdrawal. Similarly, for taxes, the government could be taxing on the household, okay, in terms of income tax. The government could be taxing on the firms, could be corporate tax, okay. So when these two actors are taxed, okay, amount that could be spent to produce goods and services, the amount that could be used to buy goods and services on the part of households will be reduced, okay, because some of it got to go to the government. All right, so this is a form of withdrawal. All right, now when the household or the firms buy things from overseas, income is also drawn out from this circular flow. This income could be used to buy things from this firm, but the household, for example, could be buying things from overseas, which means that income is being drawn away from this circular flow. All right. Similarly, the firms can buy resources not just from this household in the country, but buy from overseas. So those payments are withdrawn out from this circular flow. All right. Now, these three sectors can increase the flow through injections. Can you see the upward arrows? Okay, the upward arrows are injections that will enlarge the flow. Okay, now for example, financial institution can invest in this economy, all right, in this country. Okay, if the financial institution thinks that this economy has a potential to produce more things, all right? So it may want to invest in this economy. So investment goes in and the flow is enlarged, all right? Now the government not just tax these two parties, the government also will spend. Okay. Now what does the government spend on? The government can be spending on schools, MRT lines, expressways, right? And when the government spend, okay, it's actually injecting money into this, injecting funds into this circular flow. For example, to build a new school, the government may be hiring this firm, all right, to produce a school, and the firm needs the resources, will buy more resources from the household, and thereby enlarging the overall flow. Okay. Now, the firm may not just receive business from the households in this country or in this economy. The firms may be receiving orders from buyers outside of this economy or this country. So the firm may be enjoying export revenue. When you sell something overseas, is export, yeah. So the firms may be enjoying additional businesses from overseas and earning more from overseas, and thereby enlarging this circular flow of income. Okay, so please note that you should know what are withdrawals, examples, okay, savings, taxes, imports, and you should know what are the injections, investment, government expenditure, and export revenue. Okay, so this is a macro picture of what is going on in the economy, how wealth is created, okay, and how it is changed through injections and withdrawals by these three external sectors. Now, this slide shows you the business cycle that an economy goes through. Okay. Now, on this axis, it measures GDP, which is the income generated by an economy or country. Okay. This, of course, time in terms of year. Now, over time, okay, over time, with technological improvement, productivity improvement, the potential GDP, that means the potential earnings, the potential income of a country will tend to go upwards. Okay, with technological advancement, with productivity increase, GDP, your potential GDP tends to go upwards. Okay, very gently. All right, but in the meantime, your real GDP, that means your current income, could be fluctuating. All right. Now, in this slide, you are taught how to describe the business cycles. Okay. When income is rising, okay, we call this an economic expansion. When your income is rising, okay. When your income is falling, the downward part is called a recession. Okay. Now, we describe the U-turns as the peaks and the trough. When income goes to a height and then goes down, a U-turn, as in this case, we call this a peak. All right, it resembles a mountain top. Okay, a peak. Now, when it makes a U-turn at the bottom, it bottoms out. Okay, this is called a trough. When you do your project and you chart out the changes to your GDP, okay, this is a very useful way to describe how the data is changing. Okay, now why does GDP changes like that over time? Why can't it be gentle? Because GDP movements is due to economic activities that might not be consistent for all parts of the year. For example, in the December period, there's a huge buying, shopping spree by consumers because of the year-end festival period. GDP at the year-end would perhaps see something like this, going upwards. Okay, now when the weather is very bad, like in the US, it's a snowstorm or something, okay, because of weather or environmental considerations, GDP may take a hit, all right, because no one is buying or selling, or firms may be closed due to the adverse weather, so GDP may take a drop. Okay, so it changes according to seasons, according to time frames of the year, which is quite normal in a typical year. Now, when we talk about GDP, all right, in the lecture we have gone through this. GDP measures the income of a country. Okay, now how does it do that? it measures the value of all the final goods and services produced, okay, within the domestic territory of a country, that means within a national boundary of a country, and within a period of time. Okay, now why final goods and services? Because we don't want to double count. For example, if your country produce laptops, the LCD screens cannot be counted separately because it's included in the value of the laptops. Okay, that's an example. All right, so only final goods and services are counted to avoid double counting what you produce. Now, there are three ways to measure GDP, three methods to measure GDP. Expenditure method, income method, and output method. Most of the time, you'll be using expenditure method and income method. You need to know what output method refers to, okay? But you don't need to learn how to calculate in this syllabus, okay? You'll be using expenditure method or income method, all right? But you still need to know what output method means. Let's take a look at what these three different methods entail. Now, the expenditure method measures the income of an economy by calculating the total spending by different sectors in the economy add up together. Okay, these are consumption, C, investment, I, government, G, and net exports. Exports, X, minus imports, M. Okay, so when we look at the formula, it's C plus I plus G, X minus M. All right, so this totals up all the expenditure by different sectors in the economy, and then we can have a rough idea of what is the income level in this produced in this economy. Now, C will represent consumption by consumers. Okay, anybody that go and buy things like you and I, okay, we can buy something. This will be calculated, tabulated here. Okay. Now, it's also known as private consumption expenditure. That means the regular consumers buying things. Now, I mentioned in lecture that this is only restricted not to too expensive things. If you buy a house, then it's not included here. You buy expensive thing like a car, it's not included here. Okay, but it includes most things. Okay, it includes most things that you buy on a daily basis. This would be tabulated under consumption. Now, when the government spends, it adds on to the GDP. Okay, now what does the government spend on? It spends on building infrastructure like airports, schools, expressways, and many other things. Okay, now when the government spends, it adds on to the GDP. Okay, and this is also known as government consumption expenditure. Okay, note the consumption is still there, but it's government consumption. All right, to denote who, which is the party, who is the one that's spending. Just now was private consumers, this is government. Okay, to signal that this is another party that's spending. All right. Now, the private sector, the private companies, okay, when they spend, what do they spend on? They could be spending on buying new buildings, okay, investing in new factories and machineries. Okay, this is known as investment. Many professional journals, economic books will tell you that this is also known as gross fixed capital formation, but the meaning is the same, it's investment. Okay, so it's when companies invest, okay, spend to enlarge their production, okay, such as building new factories and machineries. So this is tabulated here. Okay, now you can see so far that every component records the spending made by different sectors. So those spending that's made by private companies is categorized under investment and total up here. Okay. Now, when you buy things from overseas, you are spending money, but it doesn't go to your own production. It goes to an overseas production, which does not count. Remember, when we talk about the definition of GDP, it is within this country, national territory. Okay, so when you spend on overseas products, it doesn't add up to your own national income. In fact, it drains away your national income. Okay, so we have to minus out the imports. But when we sell goods and services to other people, okay, overseas, we earn revenue as exports. Okay, and that adds to our national income. All right, because we are the one who produce it, although the buyers are overseas. So we include exports, that means foreign buyers of our products, but we minus out imports, which are made by overseas producers. Okay, import is the only negative component here, a minus component. Please take note. All right. Now let's take a look at the income method. Now, for the expenditure method, we tabulated all the expenses made by different sectors in the economy. Now we look at all the various incomes that's earned by this economy to measure national income. Okay, so it's a different approach. Just now we measure expenses, the things that we buy, the things that we spend. Now we measure the things that we earn, total up together, and that will be our national income. All right. Now, what we earn could be comprising of wages, salaries, okay? What you and I earn when you earn a salary, okay, that's one type of income. Now, net interest is another component of the income method. Net interest is when the interest that you earn from investment or from deposits, you minus off the interest that you pay for the money that you borrowed, like on loans. Okay, if there's something left over, it's income to you, and this is calculated under this component. Now, some people could be renting out their homes if they have many homes, or they could be renting out a room, okay, in their homes. So when you do that, you have additional source of income. We call this rental income. All right. So this is captured in this method as well. Corporate profits are amounts, incomes that are earned by private companies. Okay, now this usually refers to the big companies. Okay, when they make profits, so all the profits are tabulated under corporate profits component in the income method. Now, the last item in the income method will be the proprietor's income. Now, how is proprietor's income different from corporate profits? Corporate profits are income that is generated by big companies. Proprietor's income are the small businesses. Okay, like in this case, it's a small shop, a mama shop or provision shop. The income that they generate from their small businesses. Now, although this is getting a less common sight in Singapore, in big countries in the countryside or the suburbs, these kind of small shops are still very common and very important to the local economy. So this could be a very important component for bigger countries, although in Singapore we don't see it that much anymore. All right, but it's still a component in the income method. Now let's talk a little bit about the output method. I mentioned earlier that you're not required to use the output method, but you should know what it is. Now, output method calculates national income in a different way. It totals up all the value-adding activities in all the industries in the economy. All right. Here we have an example of a nasi lemak stall. Now, for example, how much does it cost the store owner to produce 1 unit of nasi lemak? Now, this store, maybe they have to spend $1 on the chicken, 50 cents on rice, 50 cents on vegetables. All right, now total up, the cost will be $2. But the nasi lemak store can sell the nasi lemak for $3. Okay, now when that happens, you realize that this price over here that they sell is more than the cost. So they're able to value add by $1. Okay, now how are they, why were they able to value add? How did they value add? It's because of their skills in making the nasi lemak. All right. So because of that, they value add $1 to all these ingredients. Okay, resulting in a higher selling price. So output method totals up all these value adding activities in the entire economy into a national income figure. All right. Now, if all the methods are used appropriately, all the methods should give you the same GDP amount. Okay, the expenditure method should be equal to your output method, should be equal to income method. Okay, all the 3 different methods should give you the same amount of GDP when used appropriately. All right, so that's why in macroeconomics it's very common for us to cross-use certain terms like national output and national income. Okay, it's like the same. because mathematically, in terms of GDP calculation, they're equal. All right. So GDP, some news paper would say that it's national output. Some news wires would say that it's national income. Okay, it's one and the same because the three methods should give you the same amount of GDP. Now, when we calculate GDP, which is the goods and services produced within this economy in a period of time, what value we attach to the goods and services produced is very critical. All right. Now, in the lecture, we mentioned that if we use current market prices, okay, we will get nominal GDP. Now, if we use a past year price, a constant year price, that will be real GDP. Okay. Now, we mentioned in lecture that real GDP is a more accurate indicator because prices are kept constant. Okay, nominal GDP takes the current market prices, which may be volatile, and that may give us a skewed understanding of how much is the GDP when prices change a lot over the past year. Okay, now in this syllabus, you have to learn how to convert GDP from nominal to real and vice versa. Now, fortunately, we have a very simple formula over here. Okay, it's one and the same. It's just written differently. Okay, to get real GDP from nominal, you can use this formula. To obtain nominal GDP from real, you can use this formula. Okay, please know this formula well. All right. Now, what is deflator? Now, a GDP deflator, we mentioned in lecture, this is an index showing you how the prices have changed. Now, if the prices have changed a lot, the nominal and real values will be very different from each other because the nominal GDP will be inflated by very high prices. Okay, so the GDP deflator, the use is to reduce the impact, to remove the impact of volatile prices on the GDP amounts. So when we calculate real GDP, we're actually taking away the effect of volatile prices on the GDP. Okay, so this GDP deflator is an index set at 100 and it measures price changes based on 100% of base year, the year that's selected for comparison because that year the prices are stable. Okay, so economists will pick a year in the past. Okay, now it's 2017, maybe we pick 2015 as a stable year, for example. Okay, so all the prices will be based on 2015 prices. So in this case, it's set at 100, so you read it off like an index. So a deflator of 125 means that it's above 100. That means prices have gone up, okay, more than 100%. That means prices have gone up by 25% over the base year. Okay. Now, after calculating the GDP, we want to know whether we are doing better or worse, okay, compared to last year. All right. Now, take note, we only use real GDP to calculate economic growth. Like what I mentioned earlier, real GDP is a more accurate reading of national income because it removes the effects of volatile prices. Okay, so this formula, real GDP this year minus real GDP last year over last year times 100%. So let's say if you're calculating economic growth rate for a certain year, like 2008, we take 2008 real GDP minus 2007 real GDP over 2007 real GDP times 100%. Okay, now all these amounts are in currency, okay, because it's income, it's in currency. But when we find out the rate of change, okay, rate of change, economic growth rate is always in percentage. Now, if you're unsure about this part of the mathematics, you should look at LMS. We have a tab there on Prep Math for Economics. Okay, take a look to revise some elementary math that is needed for this subject. Okay, in any case, this is on percentage change. It takes some practice and you'll be okay. All right. Now, after calculating the GDP, the amount that is derived is the total GDP that this economy has generated. Now, we wouldn't know whether this reflects the well-being of the people in that country or not. Okay, now so what do? We take GDP, we divide by the population to get this measurement called real GDP per capita. Per capita means per person. We want to know each person is earning how much so that we have a comparison. Okay, we have a clearer understanding. All right, how much each person is actually earning. Because when you have an amount, you are not sure how much each person will get until we know the population. So we take real GDP, which is the total income generated by the economy, we divide by the population to see each person gets how much, so that it can better reflect the economic well-being of the people. All right. Now, go and take a look at some of the additional materials that are put on LMS, okay, and attempt your tutorial questions. Any questions, please ask your tutors in the tutorial. Okay, see you next week.